Hello everybody. At this time we are talking about pricing methods. Pricing methods are ways of calculating the price of goods and services by taking into account all factors that can influence pricing strategy. Factors can include the product or service, its life cycle, market competition, and target audience. Choosing between pricing methods isn't always easy, but it's something no business can afford to get wrong. The best pricing method for a given company is itself based on several different factors: the scale of your company, the size of your public profile, your finances, and of course, your product will all dictate which pricing methods are feasible and which ones aren't. And then we move to three classic pricing methods. The first, cost base. One of the simplest and most traditional methods is cost based pricing. Here, the price is set by adding a profit margin to the production cost. Although it is easy to apply, it does not always reflect the value perceived by the customers or market conditions. And then the second, demand based. Demand based pricing is set based on the quantity of products available and market demand. During periods of high demand, prices may rise, while in times of low demand, prices may be reduced to stimulate sales. And then third, competency based. This approach adjusts prices according to competitors' prices in the market. This method is ideal for businesses operating in saturated markets as it ensures that prices remain competitive. However, it can involve risk if the perceived value of the product is not taken into account. And then we move to choosing the right pricing method. Selecting the appropriate pricing method depends on factors such as your business goals, market conditions, customers' expectations, and the nature of your products or services. Businesses often use a combination of these methods for different product lines or customer segments. By understanding these pricing methods, companies can make informed decisions to set prices that drive profitability and customers' satisfaction. And then we move to the important metrics that should inform your product pricing. The first about fixed costs. Fixed costs are sometimes also referred to as overhead costs. These are expenses that don't usually change from month to month. This would include things like your office space rent or your employee salaries. Sometimes rent will go up or people will receive a salary rise. Regardless, you must account for these expenses every month. You want to make sure your products are priced to cover these recurring expenses. And then the second, consumer surplus. Consumer surplus is the difference between the price that consumers are willing to pay versus what they actually pay. This begs the questions: how much money is the customers leaving on the table? Sometimes customers pay less money than they actually are willing to pay. So when calculating your prices, ensure they level up with customers' willingness to pay data. And then third, variable costs. You must also consider things like variable costs. A variable cost is a cost that changes in relation to variations in activity. For instance, if you're building a physical product, a variable cost would be the direct materials you need to develop that product. More applicable for the source would be a variable cost, such as marketing. You may strategize a new marketing sprint that requires extra spending. If that's the case, you want to change your product pricing accordingly to cover those costs. And then fourth, market demand. Your product pricing should also reflect market demand. Are you selling a product or service that's highly coveted right now? Or maybe there's a dip in demand and you're not seeing as much traction. Be sure to always be watching market trends so you can price your products wisely. And then we move to pricing methods in practice. Pricing policies are the decisions by a company determining prices to be charged for its product. There are a number of different pricing policies or strategies which a firm may adopt in order to achieve its pricing objectives. The first about scheme pricing. It uses high prices to obtain a high profit and quick recovery of the development costs in the early stages of a product's life before competition intensities. Second, sealed bid pricing. It is widely used in government, public sector, and other private sector markets whereby suppliers are invited to tender for the supply of specified goods or services. And then third, penetration pricing. Penetration pricing is the use of lower than normal prices to increase market share. It is also used to establish a new product in a market which is expected to have a long life and potential for growth. Fourth, market pricing. It is determined by the interaction of demand and supply. The seller has little control over the price in a situation which is likely to fluctuate daily. Fifth, mixed pricing. It is a policy which initially uses scheme pricing and then, as competition increases, price cutting, sometimes even below cost, to penetrate the market, increases market share, and eliminate competition. And then we move to the customer's perspective on pricing. Regardless of the pricing strategy and models adopted, it is important to highlight that the value perceived by the consumers is a fundamental factor. It is not just a matter of choosing a number depending on cost, demand, context, competition, etc., but of understanding how that number is interpreted in the mind of the customers. This means that it is not the company that unilaterally determines how much a product is worth, but that the customers assign a subjective value to what they receive. This value does not come out of nowhere. It is created and captured. Value is built in the customer's mind through storytelling, positioning, experience, and the impact that the product or service has on their life. I think it is enough. Thanks for watching.